Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Revisiting Warner Brothers Discovery. I did a video on these guys a month or so ago, bought some shares in the high nines. Rumors came out yesterday that Warner Brothers Discovery and Paramount Global are in merger talks. These are early merger talks, might not materialize, but it's always interesting to speculate why they might be doing this. Warner Brothers was down about 5% today. They're basically flat pre-market. Paramount was down about 2%. They're down about 1.5%. So maybe the market doesn't think there'll be much of a premium placed on this deal, if any. If you look at Paramount, the stock was down to high tens just a couple of months ago, and then rumors started to come out about a potential sale to various entities. Warner Brothers is the latest of many. Potential spin-offs of certain assets, etc. And the stock is up, 40% since then. So maybe the merger premium is already baked in there. Whatever happens, a deal with Warner Brothers Discovery can't really be made until at least April 2024, when the Reverse Morris Trust spinoff between AT&T, Warner Brothers, and Discovery happened. It was done as a tax-free transaction, as Reverse Morris Trusts are. And that means that for a period of 2 years following the distribution date, which was in April of 2022, they can't do a variety of things that would allow them to fund an acquisition of any sort. And funding an acquisition is the big question mark here. Paramount Global has $16 billion in debt on the books. They are a $10 billion market cap company. How would Warner Brothers fund this? My whole thesis and the market's thesis with Warner Brothers is that they are a free cash flow generative company that is using that money to pay down that debt. When the merger happened, this was a $26 stock, $25 stock, somewhere in that range. Now it's an $11 stock. Pretty big drop off for investors at time of merger. At time of merger, this was expected to be a $52 billion 2023 revenue company with about $8 billion plus in free cash flow. It's actually a $41.5 billion revenue company with $5 billion in free cash flow. So a lot of negatives here. Watch my other video for why this has been a dud and why it's also an interesting investment. My whole thesis here was that they're going to use this free cash flow, pay down their debt. The market's giving them a very high free cash flow yield based on the market cap, a 7% free cash flow yield based on their enterprise value. Even if this is fair, as they pay down this debt, some of this enterprise value will probably stay the same and flow down into their market cap. Stock price would go up. Investors would be happy. Yay. So as I looked at this, if I was targeting a 15% target return based on all of these factors here, I'll share this spreadsheet in the link down below if you want to look at it. Just hit file, make a copy. As always, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So as I looked at target returns of 15%, I had a fair value in the mid to high nines, and I was a buyer in the high nines. If I look at a 10% target return, it's closer to where it is today. So you can make a case that fair value of 1166 is there at today's price point. I have an 1181 based on these assumptions here, with the assumption that they're going to keep paying down debt, not with the assumption that they're going to acquire more debt and potentially dilute shareholders by issuing shares to pay down that 10 billion in market cap that they would have to pay in order to acquire Paramount. So interesting acquisition for sure. Why would they want to acquire Paramount? Well, again, they want to expand their media empire. This is a $30 billion a year revenue business, even though it's not really growing anymore. And if it is, growth is slow. The main issue I have with Paramount is in the last couple of years, their EBITDA margins have shrunk considerably as they made investment into their direct-to-consumer streaming side of the business, and that's led to very negative free cash flow and or barely positive free cash flow. However, if you look at this business from a historical perspective, before those investments were made, this is a business that was anywhere in that $1 to $2 billion free cash flow range. $2 billion is probably a bit overstated because this was during the pandemic year where production was shut down for a lot of the year and they were still making money from streaming and their linear TV. Obviously, the risk here is that linear is kind of dying. They have to move into other spaces, and those other spaces have not been as profitable as expected, and growth has slowed down on the streaming side, which is another reason that WBD stock and Paramount stock and a lot of these entertainment businesses are down because they're investing in a business that's not growing as quickly as expected and not generating money. So as we look at Paramount's assets and their earnings, so they have a direct-to-consumer business that has a lot of overlap with what Warner Brothers already offers. And their direct-to-consumer business is burning cash. It's about 1.1 billion in negative OEBITDA, operating income before depreciation and amortization. So probably burning free cash flow night and day. If this is for 9 months, if you look at a full year period, it's probably closer to negative 1.5 billion. So you're investing money as Paramount into Paramount Plus. If Warner Brothers were to acquire this, why have two separate streaming services? They could basically kill Paramount Plus, stop the investments there, save a bunch of money, probably move all of that content into their Max offering, probably move a good portion or at least a part of these 63 million subscribers that are on Paramount Plus into their Max offering, because all of that content that is on Paramount Plus would move into Max, make their direct to consumer offering probably a lot more profitable, and then save costs on this end. They could keep Pluto TV because they don't really have a lot of fast offerings on their end, and Pluto TV is growing pretty well. For BET Plus and Noggin, both are already on the sales market. BET Group has a $3.5 billion offer on the table as of yesterday, I believe. And Noggin, there were some rumors of a potential sale. So the idea here would be, this is a business that's burning free cash flow, Paramount, but it's burning free cash flow because they're making investments on their direct-to-consumer segment. If WBD acquires them, that's not needed. Moving on. That's really the thesis here. Secondly, they have a TV media business that is also something that WBD has. And the nice thing about TV media is, even though it's shrinking, and there's no doubt about the fact that it's shrinking, it generates a lot of free cash flow. It generates a lot of EBITDA. You can kind of see in the 9 months ended here, even though it's down 12%, it's 3.6 billion in EBITDA. I'm going to call it EBITDA. They call it EBITDA, whatever. It's just easier. For the full year, it's probably closer to 4.5-5 billion. So this is a free cash flow generative business that's being offset by the investments they're making in the direct-to-consumer business. If Warner Brothers Media were to acquire them, they don't need to make those investments in the direct-to-consumer business, but they get all these channels that are generating free cash flow already. They could add that to their stable of channels that are also generating free cash flow and potentially make Paramount a free cash flow generative business. That would be the whole thesis here. Yes, they're taking on debt, but if they can make substantial cuts to Paramount, and that's essentially what's going to happen, and it's probably why the people who love television aren't going to love this deal, because Zaslav is going to come in here, say, Paramount, you guys are losing money, we're acquiring you, we're going to make you a company that makes a lot of money for us, because we're going to need to take your business, make it a free cash flow generative business, and start paying down the debt we took on to acquire you. That is the thesis behind this acquisition. I think that is how they're looking at it. They're looking at, hey, we're going to acquire some pristine assets. We're going to acquire CBS. We're going to acquire Nickelodeon. We're probably going to sell off some of these assets. We're potentially going to scrap a lot of these direct-to-consumer services besides Pluto TV, and or sell them off. Potentially, we're going to kill Showtime. Why have Showtime when you already have HBO? Is there really a need for Showtime? There's a lot of cost savings you can make here. There's still going to be expenses that they're going to have to do on the Paramount side. Paramount produces a lot of content. They can certainly continue producing a lot of content. It's just that the content's going to go on HBO Max, or Max, I guess, at this point. It's going to be, hey, Max now has Survivor. It's got all the HBO content. It's got all the Warner Brothers content. It's got Yellowstone. It's got NCIS. It's got NFL. Max is introducing this Bleacher Sports add-on that's going to cost $10. You throw in your NFL stuff on there if you can. I don't know what the deals are like, but as you renegotiate those deals with the NFL, now you're one company that has all of these assets. You've got the NFL under one package. You've got the NBA under one package if they renegotiate those deals. You can add other assets. You've got the ability to be a bigger company, to negotiate better deals, to compete better with the Amazons and Apples and Googles of the world that are getting into the sports space. And in order to compete with them, you have to be a bigger, more efficient company, and combining CBS with Warner Brothers and Paramount together and cutting costs to the bone is the way to do that. It's not going to be great for users of these products. You may say, well, that's not good for users. Why would the FTC allow this to happen? Well, potentially because they think that Paramount doesn't have the ability to survive that much longer as a standalone company. Is it better to let Paramount go bankrupt, or is it better for them to be sold off for parts and or sold off to a company like WBD? I think the latter is probably better than the former. Now, I'm not saying that Paramount's going to go bankrupt tomorrow, but with their debt load, with the fact that they're not generating free cash flow, if that doesn't change quickly, and it could, they could be in trouble. So there's a reason that Paramount is saying, hey, we're up for sale now, when their stock price is as low as it's ever been, versus being for sale a couple of years ago, because now they're in more trouble than they were a couple of years ago. Then as you look at their film and entertainment space, again, it adds a couple of assets, including Mission Impossible, all of those things to the stable of Warner Brothers movies. But also it's an asset that potentially overlaps with what Warner Brothers already has. If the FTC comes in here and says there's too much overlap, would there be a problem with WBD saying, we already have Warner Brothers Studio? Do we need Paramount Studio as well? Can we sell Paramount Pictures to somebody else? There's always rumors that Apple is going to acquire Paramount, but they're not going to acquire Paramount because they don't want legacy television. They're a tech company. They don't want to manage CBS. However, with their TV Plus service, maybe they want to have an in-house studio that they can use to produce content for themselves. And potentially Apple could be an acquirer of Paramount Studios, because Warner Brothers can look at this and say, yes, we're spending $26 billion on Paramount, but we can get $3.5 billion from BET Group. We can sell Noggin for $500 million. We can, maybe we'll sell Showtime instead of just killing it. Maybe we'll sell Nickelodeon because we already have Cartoon Networks. Maybe we'll sell MTV because it's not really an asset we want. Maybe we'll take a look at Paramount Studios and Nickelodeon Studios because we already have production capacities in-house. We'll keep some of these assets. We'll keep Top Gun and we'll keep Mission Impossible and we'll keep Paw Patrol or whatever assets we own, but we'll sell the actual studio themselves. They have real estate that they can sell. They have real estate that they can do sale leasebacks on to raise money. So there are assets in here that can be sold off while retaining the assets that you want to keep. There's enrollment in a service that provides content that people want because it has 63 million enrollees that can be moved into your Mac service, which is now reaching kind of critical mass as far as profitability goes. If you add even 30 million additional subscribers because of this merger, because they want those Paramount assets, it could actually be profitable. So that's how I look at this. That's how this would make sense to me. Again, I don't love it, but at this point, it's just a rumor. There's nothing more to it than that. On top of that, there's already been rumors that Comcast and NBC Universal, which Comcast owns, is also interested in a merger. Because if you think about, if Warner Brothers goes after Paramount, they become bigger. What happens to NBC Universal? They're kind of left without an ability to grow through acquisition because there's nobody else really to acquire. Disney already acquired Fox. Now WBD is looking at Paramount. Will NBC Universal come out of the woodwork and say, well, I think what Warner Brothers Discovery offers kind of fits with what we already have. They don't have one of the big four broadcast channels, so there's less of a concern around actually making the acquisition work from a regulatory standpoint, because if NBC Universal were to acquire Paramount, NBC and CBS probably would not be able to exist together. They would have to sell one of them. However, if they acquire Warner Brothers Discovery, there isn't that big four overlap. So they might be able to get that through regulatory scrutiny a bit easier than if they were to acquire Paramount. I mean, at the end of the day, any of these mergers will probably face a tough uphill battle in this regulatory environment. I think the FTC will say, we're certainly going to challenge this. Whether or not it plays out in court and how it plays out in court is tough to tell. But if Warner Brothers Discovery strategy is, we're going to go to the table with Paramount in order to get NBC Universal interested in us and have a buyout offer for us, that could be good for WBD investors as well. So that's kind of how I look at this. Do I love the potential acquisition of Paramount? Not really, because it kind of goes against what my thesis was in the first place. I don't want them taking on additional debt. I certainly do not want them issuing shares at today's prices to fund this acquisition. And if they do, that kind of sucks, unless they think they can take Paramount, which is if they have to issue $10 billion in shares, that's a 17% free cash flow yield. If they think they can take Paramount from basically a flat free cash flow company, and by closing, killing Paramount Plus, selling off all of these underperforming assets, selling off some of these other assets, pay down that debt really quickly and improve free cash flow by, let's say, $2 billion, which is probably optimistic. That would be a 20% free cash flow yield. That would play out fine, but I don't know if that's realistic. If they issue more debt, they still have to do that. They have to take this asset that's not currently generating free cash flow and have it generate free cash flow. They can start paying down that debt quickly, because that's what the market needs from them. That's what they have to reassure the bond rating agencies that their debt isn't going to be a huge issue. They're already kind of in that on that, you know, junk bond area. If they hit that, that's going to be a problem from a long-term perspective when and if they have to refinance debt. And again, this isn't a slam dunk by any means. And if I had to say, would I want them to do it versus not want them to do it, I'd probably prefer them not to do it as a shareholder of WBD. But for all the things I mentioned, I can see why they would at least consider it. And if it ends up being NBC Universal making an offer for WBD, I think from a long-term perspective, that kind of sucks because I think WBD could have, mid-teens plus long-term returns annually for a while. And an offer probably won't do that. It'll just be, hey, here's a 30% premium. But hey, a short-term return is something I'll take as well. So those are my thoughts on the acquisition. Let me know what you think. Are you excited about WBD potentially acquiring Paramount and killing a bunch of their assets and just deleting them from existence as they've done with certain things on Max and their platforms? I'm sure certain users are not. From an investment perspective, what do you think about this? Let me know what you think. As always, thanks for watching. Like the video, subscribe, and bye.